Well, we conclude our inflation equation series today with a look at how to protect your investments from future inflation. Martin Hegarty is the co-head of global inflation-linked portfolios in BlackRock's fixed income group. He manages $23 billion of the $3.65 trillion the firm has under management. Martin joins us now with some insight as to how the bond market is reacting to this. Martin, thanks for joining us. Great to have you here in the studio. Let's talk about the types of securities you invest in your portfolio.
Sure. Well, thanks for having me, Lisa. Our portfolio and the philosophy behind our business at BlackRock and our inflation business in particular is we look to generate alpha and returns from inflation-linked products and rate products. So our portfolios are predominantly consisting of U.S. inflation-linked bonds, whether that be in the U.S. or on a global basis, European, UK, Australia, Canada, etc., inflation-linked bonds. We'll occasionally take when inflation expectations are elevated, we may make an allocation to nominal treasuries, as well as in some of our more flexible accounts, used interest rate derivatives as a way to try and generate extra alpha, hedge duration, etc.
Now, we've been talking all this week about Federal Reserve Chairman Ben Bernanke's comments. He mentioned inflation quite a few times. That's a big driver of performance in your portfolios. Did you agree with his comments? I
think the one point that I agreed with Bernanke is when he was asked about QE3 and whether we are on the verge of seeing QE3 when QE2 winds down. I think the point he made was pretty significant when he said, given the current elevated level of inflation expectations, embarking on QE3 would probably be detrimental at current levels, despite what the unemployment picture looks like. So to me, that the Fed has a dual mandate of price stability as well as keeping unemployment down at a level consistent with low inflation. I think they're moving the inflation target sort of front and center now that unemployment has rebounded off the lows. And if we look back to Q4 last year when core CPI printed at 0.6 in October, we've rebounded pretty aggressively from the lows. And I think they're moving, and they want to keep inflation expectations well maintained. And we've moved aggressively away from the zero bound that the Fed was looking to steer us away from.
We left it off. We were talking about the Federal Reserve. The Treasury market at this point, we haven't seen the 10-year yield move that much, really. It's really been moving lower. When are they going to raise rates, the Federal Reserve? And what is the bond market saying about inflation?
I think there's different messages being sent from the bond market depending which part of the curve you look at. I think to address the first part of your question as to when the Fed will raise rates, I think Bernanke pointed it out pretty clearly to us the other day that they're watching inflation and inflation expectations very, very, very closely. And when you look at some of the commodity markets, they continue to remark that inflation is transitory. And when you look at the slopes of the various commodity curves, you look at, say, corn, for example, priced out 18 to 24 months down, it's actually trading 30% lower than the front contract. So when you look at crude as well as other commodity markets, it does appear that this surge in headline inflation we're seeing may be transitory. What is in favor of Bernanke actually standing pat for the time being is when you look at wage data and personal income expectations. You saw the University of Michigan data released this morning. Families are not expecting their financial position to be much better 1 year forward. And that, I think, is a little bit of a concern.
So, Martin, I'm going to break in because we got about 20 seconds here.
Okay.
Earlier this week, we had a guest on who said tips are too expensive. How are you positioning your portfolio?
I think that's real rates are incredibly low, and how we're positioning our portfolio as a result. I think there are parts of the curve that are reasonably attractive, and given the slope of the real yield curve, I think the long end of the real curve even at 175 is attractive on a relative basis. We are running a slight real rate short in the belly of the curve. I think there is a lot of positioning out there skewed towards the carry trade with the Fed standing on pat.
We have to end there. That was Martin Hegarty.